Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, with John Mousseau. You know John very well. I'm going to jump over to John first. We're 10 days into January 10th today, and we've had volatility in all asset classes, fixed income, commodities, and equities. John, fixed income kind of throwing each asset class for a loop.
Yeah, I'd like to be in the transporter room and go back to October 10th and 2 more months of the year. It has been brutal. You've had rises in interest rates so far this year. 10-year bond as we sit here is a 4.77. To put that in perspective, go back to September 18th when the Fed cut rates 50 basis points. That number was at a 3.70. So you're up over 100 basis points in that time frame. Tax-free yields up half of that. Important thing to look at. Where's inflation versus that? You know, trailing inflation when they first cut was at 2.5. Where is it now? It's at 2.7, a little bit higher. It is a combination of things. It is a little bit of the fear of inflation. It is definitely the fear of more spending out of the Trump administration once they get in another week and a half. Right. It is definitely fear that maybe you look at today's jobs number, which surprised people on the upside. It is some of that. You'll know more with the CPI and PPI data next week. But, you know, as we've talked about, you're at real yields now that are above 2%. We've always talked that's kind of a number that we haven't seen in a very long time.
And real yields for everybody?
Yeah, real yields are, take the nominal yield, subtract inflation, it's what you got left over.
So take a 4.77 10-year, back out inflation, and we
back
like
out,
to look at
back
that
out inflation of 2.7, you are over 2%. And you can use other measures of inflation and be higher than that. Use a couple of more, maybe be a slight lower, but it's certainly 2 is the over-under.
How long has it been since we've seen 200 basis points of real yield?
Well, you have to go back to the before the financial crisis, because remember you had the Fed cut rates low. You went a long time period from end of 2008 to 2015 with the Fed practicing quantitative easing, right. So buying longer bonds, keeping short rates low. So you were at negative real rates for a long time. You can make the case we're going back to normal, which has taken some getting used to be honest.
Yeah, although when we look at it from that view, bonds doing their job, keeping out in front of inflation from a coupon standpoint.
Exactly, and as you've talked about many times, when you get to these higher coupon levels where you're maybe not at 5 again on the 10-year bond, but you're between 4.5 and 5, and you're getting close to 4.5 on a longer tax-free bond, those are big differences from a few years ago where they were much lower. So those coupons are kind of the ballast for portfolios.
It's cash flow.
And keep chugging.
Cash flow, compounding cash flow.
Exactly.
In fixed income. And those higher rates in bonds have hit, I shouldn't say hit equities, but created volatility in equities. Why? Equities trying to price in that bond yield. Valuation on equities, depending what type of equity, sectors or industries, growth value, they work off of a risk-free return on the bond side. So if we're looking at a 10-year at 4.75, 4.77, whereas 3 months ago, the thought was multiple cuts in 25. Maybe the Fed funds rate gets down to 3, and the 10 years a 3.50, right. And the 30 years a 4. Well, that's not where we are right now.
No.
So you have people out of position in fixed income and out of position in equities, just trying to find a price level that can deal with those rates. A little bit different than 22 when Fed was going higher, and markets were equity markets were trying to guess at where that high was. You know, I'll throw my opinion out here, and that's worth next to nothing. Opinions in the markets hold no water. Price holds everything. In terms of bond yields, I'm not as nervous as other people right now.
There's good reasons not to be as nervous because, you're at levels where those coupons kind of carry along.
They compound, but even the effect I'm saying on
Yeah.
equities. We had a little sugar candy for a long time where rates were 1% and 1.5%. The reality is equities, they can deal with rates up here as long as the economy stays strong or in decent shape. What did we do this week? We've had some drawdown. Keep in mind, December, the equal weighted S&P was down over 5%.
Right.
That's continued into January. That's starting to create some reasonable levels. Now, the cap-weighted S&P, which we're all familiar with, the S&P 500, that's starting to play a little bit of catch-up to the equal weighted.
Right.
We often say if the soldiers are in retreat, sooner or later the generals are too.
You betcha.
You're seeing that a little bit. We did put some money to work this week. Maybe early by a day, maybe early by an hour, maybe right. But we did in our tactical trend portfolio add some Qs. It's a current position, just added to it. It's come down to an area that has offered support previously. In our U.S. core portfolio, we added to our Vanguard growth. Keep in mind, we mentioned this last week that we didn't want to chase it on Friday.
Right.
And we felt maybe we missed it. Well, it's come back to us. And today, in our U.S. ETF portfolio, we added some cloud computing exposure through a ETF called SKYY, SKYY, one we've had on our list. It came into the area that our traders have been eyeing for SKY.
Right.
And we started an initial position, not large, 3% position. We'll have no problem taking that up to 5 or 6% over the next 30, 60, 90 days.
Yeah, and on the bond side, for next week, we're finally going to start to see some issuance, which we haven't had. And if you think about it, it's doing the backdrop of what the Treasury yields have gone up. You might get some yields that you haven't been able to see in a while, and a chance to add some yield to portfolios, maybe do some tax loss swaps, and to put some money to work that rolled over at the beginning of the year.
Yeah. So next week, the week after, until things can price in bonds, which means until bonds level off, we're going to continue to have volatility. We do have some cash in the portfolios. We'll put that to work at what we believe are reasonable levels. The market will decide if indeed they are.
As it always does.
So you've got a big weekend of football, I know, Moose.
Oh yeah, we have 6 playoff games this week in the NFL. So
well, I hope everyone enjoys their weekend. We'll see you next Friday.